Welcome to another unit in this course on economics. This time I'm going to talk about inflation, and I'm doing this in two ways. First off, I try to motivate how we can actually calculate the inflation rate. And after this, we're going to have a short discussion at least of the effects of inflation. So when we start with inflation, we need to remember that inflation in its essence means nothing else than an increase in overall prices. So we need to be able to measure the overall price level. And the way to start with this is by using a so-called representative basket of goods. So we are thinking about which are the most commonly consumed or used goods in an economy and what are their prices. If we then also know the quantity by which these goods are produced, we can calculate what the average household pays in a year, which then would give us the price of the representative basket of goods and its contents. However, this has a few problems. The problems are, for example, usually you think about households if we talk about consumption, but companies can also consume. However, a company will consume something totally different than a household. And for this reason, there's also a difference between inflation based on so-called consumer prices or the consumer price index, which takes into account what consumers actually consume, more or less what households consume, and the producer price index. That's like a price index based on a representative basket of goods for companies, for firms. So that's what the average firm consumes. Here, we're mainly talking about the representative basket of goods for households because we're interested in the consumer price index. That will also be the next step we're going to talk about. But before we get there, we're talking about the most commonly used and consumed goods for households. So how many should this be? Well, in Germany, it's roughly 650. Depending, those goods are also changed over time. So new goods are added. If new goods become important, older goods are shifted out if they no longer are relevant. So this is a number in continuous flux. Well, it differs also across countries. Well, as I said, Germany, 650. There are other countries with less than 650 goods, which they consider important to reflect overall consumption in an economy. However, there's also a trade-off. The more goods you consider, the more exact your measurements will become on the one hand, but the more work you actually have to invest to assure this level of correctness, this level of exactness. Because, for all the goods which you consider important, you need the prices and you need the consumed quantities. So both of these numbers increase if you increase the number of goods in your representative basket of goods. That's why in Germany it decided 650. That's not everything which is consumed, but it's a good enough sample of the most important goods and services consumed. In addition to just the quantity, we also sample the prices. As I said, that's the two things we need in either case. However, it also makes sense to sample the quality. Why the quality? Well, simple example, the normal computer, which you might use, was added in Germany in the early 1980s. However, the average computer of the early 1980s is something absolutely different as compared to what you are using right now. So there's a significant quality shift. So quality in one way or another needs to be introduced into the basket of goods as well. So we need some information on quality issues. And well, what then about the sample size, about prices? Well, in Germany we have roughly 600 price collectors who collect about 300,000 prices from specific stores across the whole country in specifically determined markets. In addition to this, we have roughly 60,000 households who report, some of them what they buy and consume, some of them also in addition to what they buy, when they buy it and how much, what they pay for this. So here we have an additional input besides the quantity, also in part on the prices paid. And well, this gives us a relatively good snapshot of the most important goods, the quantity consumed, their prices, so allows us to calculate the price of the average basket of goods. However, the problem is if the basket of goods changes, so do the prices. So something which actually makes more sense is some kind of relative measure. And for this, as I said, we're using here the consumer price index, which can easily be calculated based on what we know about the basket of goods and the price for the basket of goods. Because what we're doing here, first off, is we fix 1 year as a base year. Usually, this is a halfway economically stable year because we use this as reference basis, so it makes sense to use like a normal year and not some crisis year. And then this base year is adjusted approximately every 5 years. So once we fixed this base year, we can actually start calculating the consumer price index. And that's a pretty straightforward formula. What we're going to do here is simply take the price of the basket of goods in a particular year, so call this year X, and we divide this by the price of the basket of goods in our base year. And we're doing this for all years. So each year is assigned price of the basket of goods in a particular year divided by the price in the base year, then usually times 100. This has one big advantage. We know in the base year, well, will be the same in the numerator and the denominator, so we get 100 in the base year. This allows us to easily compare present and past situations to the base year, because we know is the value we get higher or lower than 100, and we also know how much higher, how much lower than 100 this is. And if we compare to 100, this means we directly get the change as compared to the base year. In this case, however, it's always a comparison of year X to the base year and not a year-by-year change. And that's where the consumer price index already gives some information on price changes, but it's not directly the inflation rate, as the inflation rate usually is determined as the year-to-year change. Well, however, as I said, that's a first good idea to compare price developments over the years. And if we want to get to the year-to-year inflation rate from this, this is also easily done, because what we can simply do for the inflation rate is calculate the growth rate of the consumer price index and then multiply this with 100. So if we want the inflation rate for year X, we're simply taking the consumer price index of this year, subtract the consumer price index of the year before, divide this by the consumer price index of the year before, and multiply the result with 100, giving us the inflation rate of year X. So that's relatively straightforward and easily done. So we start with the basket of goods, determine the prices, calculate the consumer price index, and then calculate the growth rate of the consumer price index, and we will end up with the inflation rate. Well, that's basically everything on how to calculate the inflation rate. However, there are a few problems related to this. And that's that if we work with this schematic, what we get in the end is slightly distorted. That's due to three main reasons. Those reasons are, first off, a substitution distortion, a delay for the introduction of new goods, and a delay for phasing out older obsolete goods, and problems regarding quality changes. Well, the first part is that some goods are not, omitted fully. They might just be replaced or substituted by similar or other goods. The delay with new goods, we already in part talked about this, because, we have a decently sized sample, but new goods are added every time, new goods and services. So we might be forced, especially if they start becoming very relevant in our society, to introduce new goods. And this actually leads to the question, when are new goods actually added? When do we consider them being as relevant for the society if we do not really monitor how much of them is bought? And that's a big problem. So here we actually need to have some guesswork on when a good actually becomes important. Well, this might take some time, so this will lead to a short, usually very short delay of the introduction of new goods. Quality changes, I illustrated this already with the example of the computers. So we need to find a way to include such quality changes in the goods and services as well. Of course, similarly to the second part, there's usually a delay involved with this. So, taken together, all these three aspects distort the inflation rate and usually distort the inflation rate in a way that it becomes slightly larger than it actually is. This is also one of the reasons why, for example, the ECB says we aim for an inflation rate of 2%, a little bit below 2%, because they assume that if they go for 2%, the real exchange rate will actually be relatively close to zero. Okay, so much for inflation rate, for problems in calculating the inflation rate. So to conclude this session, what we can do is we can talk a little bit about the effects of inflation. And here we have 6 points we can go into detail. The first is that if we have inflation, money loses its value. So if you're a creditor, the money you lend to a debtor actually becomes worth less. So if you get back the same money at a later point in time, the money will be worth less. And even if you're paid an interest, the interest first has to make up for the loss due to inflation. So first off, you're battling inflation and only what is left afterwards, so only the real interest rate. That's your gain in the investment. So inflation always puts the creditors into a worse situation, the debtors into a better situation. Also, taxation will act more strongly. Why is this the reason? the easiest way is to consider taxation of interest being earned. As I mentioned earlier, the interest payments need to be higher if you have inflation so that the real interest is still positive. However, if you have higher interest rates, this means you will get higher interest payments and you have a higher tax basis and have to pay more taxes. So you will be taxed much more strongly, and all the effects that taxation has will be pronounced more strongly. In particular, in the micro part, it can be shown that taxes lead to a deadweight loss. So this deadweight loss will be more pronounced if we have higher inflation and taxes. A third aspect would be adjustment costs. Adjustment costs in two ways. That's also more or less the fourth part. The adjustment cost means that companies need to adjust to the prices. So for example, if you have an online store, you have to update prices on a regular basis, which takes time and effort. This has the problem that prices are not always at their actual current level. So prices can no longer, that's directly the next part, can no longer fulfill their signaling function. Tell anything about the value or the rarity, the scarcity of specific prices. So in other words, due to the fact that prices change very fast, the value of money changes very fast, the adjustment of prices usually is slightly delayed, and this will distort the market mechanism, which depends on exact prices all the time. So perfect decisions on a market can no longer be made if the price mechanism is faulty. So that's the fourth problem. The fifth problem builds on this, because if prices and the market mechanism built on prices is faulty, we can no longer make efficient allocations in as to which goods should we actually consume if we want to optimize our consumption. So we no longer have the possibility to maximize our utility, because we do not really know, due to the price fluctuations, which good actually has the best utility per price ratio. So this leads to faulty, wrong allocations and thereby losses in welfare, losses in overall utility. And the final comment is the problem that due to inflation, government might be motivated to increase their debt position. Well, the easiest argument in favor why this could happen is, well, creditors are said worse off, on the other hand, debtors are said better, because the money they have to pay back will be worth less. So the incentive for taking up debt will increase for private debtors, but also for the government. Well, that's then it. Also regarding on effects of inflation. And this concludes this section on inflation, on the money market. I hope you enjoyed this section. So I say goodbye and see you next time.